everybody, welcome to a new RRG video on Wednesday, the 27th of August, after the close of the US market. And I'm late again, stretching the time between those videos, and I shouldn't, so I'm sorry. I'll try to better my life. Anyway, it's a good time to take a look at a few relative rotation graphs and see what the markets have in store for us. The first RRG I want to look at is the one for asset classes. And I know we haven't looked at that in some time, but it's very static, or at least showing us quite similar picture over the last few months now. And what you see is that obviously Bitcoin is way to the right after that huge rally, and it's now losing some of its relative momentum, but the trend is still there, especially when you compare it to VBINX, which is the benchmark in this chart. But let me take this away here and just give it a little bit more room. What is probably a more major rotation here, or not rotation, but a static situation, is that stocks SPY remains inside the leading quadrant. We've seen a bit of a loss of relative momentum, but it continued to move higher on the RS ratio scale, which means that it keeps continuing to build up relative strength, although it is at a lesser pace. That's why the momentum is dropping, but the relative trend continues to improve against VBINX, which means the fixed income asset classes. So that's GOVT, LQD, and HYG. They're all incorporated in VBINX. And you can see that they are all moving to the left side. If I highlight those, then you will see that in more detail. So all these three fixed income components are losing relative strength. Now that means that the message here is that stocks are still the preferred asset class. No matter what the movement of the stock market is, even if the S&P goes down, it's still outperforming these LQD, HYG, and GOVT ETFs, which represent the various fixed income asset classes. And it means that they go down even more. So if stock market goes down, they go down even more. If stock market goes up, they go up less or down. Anyway, hope it makes sense. Bottom line is that stocks are still the preferred asset class over the fixed income stuff. And when you look at GSG and DJP, once again, commodities are losing relative strength and relative momentum. They are trying hard. If I go back over, I don't know, maybe the last 2 years of these videos, every time it looks as if commodities are picking up and making this huge bottom move, and then they drop back again at the cost of stocks. So we'll keep an eye on it, but for the time being, it's SPY, it's stocks that's driving the market. US dollar picking up relative momentum, but in this composition, still a very weak asset class. While we're here, let's quickly dive into the sectors then. So we've got that over and done with. And here the rotational picture is also quite similar over the last few weeks. And technology continues to drive the market, continues to be the leading sector here, at least on this weekly time scale. We're losing relative momentum, but the RS ratio reading is still well above anything else. If we look at industrials, they're inside weakening, but they're already starting to kind of bottom out on the RRG, which potentially means that they will start rolling back up towards leading, which would be good for the industrial sector. It's one of the leading sectors at the moment. Communication services have crossed over into lagging, but you can see that it is a relatively short tail. That means that there is not a lot of power behind that move. It is close to the benchmark, which means that that sector is moving more or less in line with the benchmark, and it has started to curl up over the last 2 or 3 weeks, which means that it's already starting to pick up relative momentum. So that's in a way a good thing. If you read it from the right to left on the RS ratio scale, it's still the third sector in the ranking. So still very good, despite the fact that it's inside the lagging quadrant. The most interesting sector at the moment, or most promising maybe I should say, seems to be consumer discretionary. Look at this move here. It hooked back, and over the last 1 to 3 weeks, you see that move accelerating towards the leading quadrant, where the distance between the nodes, we call that RRG velocity. That is an indicator that looks at the strength of that tail, is picking up speed and pushing XLY towards the leading quadrant. So that is a good sign. It's one of the very few, if not the only sector that's traveling at an RRG heading between 0 and 90 degrees. So this is a sector we should definitely keep an eye on and focus on, because it's one of the sectors that is actually picking up steam. And then there's got a whole cluster here. All these reds are inside the lagging quadrant. We've already talked about communication services. If we talk about materials, financials, utilities, they're all inside leading. Financials starting to pick up a little bit. So has materials. Utilities is still moving to the left, but has picked up some relative momentum here. And the stuff that's really bad, I think, is energy, real estate, and staples. They are all inside lagging. They're pushing lower on the RS ratio scale, and they're either in zero or stable negative momentum or building up negative momentum. Healthcare, on the RS ratio scale, the lowest reading still, but picking up relative momentum. But this is at such a low level that pickup of relative momentum probably has to be seen as a recovery within a longer term relative downtrend. Maybe it starts to make its move, but I think we will see, and we will have plenty of time to detect whether there is going to be a turnaround in relative trend for the healthcare sector. It doesn't look like that for the time being. While going over markets and looking at some RRGs before recording this video, I took a look at the equal weight sectors, and just looking at that RRG of equal weight sectors basically reminded me and confronted me with the fact that I don't do that enough. I should look more at those equal weight sectors, because sometimes they give a very different look of the markets, and I think that's the case right now. So if we switch to the equal weight version of these RRG, now look at this here. We still have technology at the highest level and losing relative momentum. But look at financials, which was kind of like here picking up on the cap weighted version. It's actually pushing into the leading quadrant here. And here is industrials, which is on the cap weighted inside, weakening and starting to curl back up. It's still very solidly inside the leading quadrant on an equal weight basis. But look at consumer discretionary. Remember when I said that on the cap weighted version, consumer discretionary was the only sector at a positive heading? Look at the difference between this tail. If I go back here. So here is consumer discretionary cap weighted, picking up relatively short tail. And here it is equal weighted. And if you dissect those two tails, compare those two indices, those two ETFs, the cap weighted one is top heavy with the top stocks in that sector making up most of the weight, so they have the most impact. This one, they're all equal weighted, and that means that basically these these heavyweight stocks in XLY are actually keeping the sector down versus the S&P, because if you look at the equal weight, and that means that there is way more weight to the stuff that's underneath the heavyweights, it's pushing straight into the leading quadrant. So I think that this sector is particularly interesting because the cap weighted is starting to move, and that's, as we know, heavyweight, driven by the heavyweight stocks. But RSPD, the equal weight version of consumer discretionary, is making a magnificent move into the leading quadrant. So this is the way I look at it on this RRG, it's a pretty broad-based rally, pretty broad-based, widely carried, good breadth, relative move for the consumer discretionary sector. Now, combine that with strength in technology, with strength in financials, and with strength in industrials. Those are all cyclical, offensive sectors. And if you then look at the moves of consumer staples and utilities, which are typically defensive sectors, and they're moving in a negative direction, and they're doing the same on the cap weighted version. So we've got consumer staples here and we've got utilities here. Then just by looking at the cap weighted, but also the equal weighted RRG, I think we have to conclude that cyclical growth stocks are still the area of the market where we should look at, where we should concentrate on, because it looks like these sectors, growth, cyclical orientated sectors, are driving, and with the defensive sectors lagging and inside the lagging quadrant, that kind of paints a picture which is positive for stocks, which then aligns with the RRG that we saw for asset classes, which is also pointing for stocks being the preferred asset class. Now, one more thing about the consumer discretionary sector, and I know that we looked in depth in previous video, the video before, so I'm not going to do that again, but a little trick that I use to sort of back up a view like this is to load up the XLY, so the individual stocks inside the consumer discretionary sector, which is this one, which uses XLY as the benchmark, and then change XLY to $1. And what that does is it actually makes the RRG look at absolute price trends, because $1 is a benchmark that is static. It never goes down. So basically, you're looking at stocks that are in an uptrend or in a downtrend. So all the greens are in uptrends, weakenings are uptrends that are losing speed, lagging are downtrends, and improving are downtrends that are picking up. It's that easy. And if you look at this, I hope you agree with me that the majority of the individual stocks inside this sector is inside leading and pushing further into leading. By the way, it's very easy to see which stocks you should not own in this sector. Lulu, LQG, CMG, KMX. Those are the ones that I would immediately disqualify from any portfolio. Probably also DRI. What's inside here? ABNB. Those stocks at a negative heading, either inside weakening or inside the lagging quadrant. There is so much more to get inside this sector. So this is a little trick to look at the breadth inside the sector. So we looked at stocks are outperforming VBINX. If you look at the sectors, we saw that especially XLY, consumer discretionary, is doing really well on an equal weight basis. Still good on a cap weighted basis. But then if you look at the individual stocks, they're all powering ahead and in price uptrends. So I think that that's enough kind of a foundation argumentation why the consumer discretionary sector is actually very interesting at the moment.
If you're watching me talk about RRG on the Stockcharts TV channel and you cannot replicate it, that is because you are not a member yet. If you like what you see and you would like to have the same functionality as what I'm using in my videos, at least take a free trial, check out the functionalities of RRG, and after that, we'd love to see you as a subscriber to our service.
Now, we are approaching the end of the month, and I know that there's a lot of people who like to look at seasonality, and I look at that here in these videos on a regular basis. And I want to quickly go over my views on seasonalities and see where we are in the rotational picture right now. So I've created my custom indices that show seasonality a little bit more granular than the standard seasonality, which looks on a month-to-month basis. Now, for those of you who have never seen this before, a quick reminder. What you see on this chart is the black bars here is the actual price chart of the S&P 500. The shaded candles below it is the seasonal pattern of the S&P 500 over the last 2 years. So I should actually start to update my files and expand it into 2026 to get a better handle. But this allows you to kind of peek ahead on what the seasonal pattern was over the last 20 years. This is the average move over the last 20 years. And then I use the rate of change, the 12-week rate of change, basically to detrend and enlarge the moves between the highs and the lows, because it looks as if the market always goes up like that, but obviously we know that didn't happen. And a very good example was earlier this year when we had that drop from, so this was six something down to, what was it here, 480. It's hard to read because my primary is the seasonal pattern, which is based around 100. And then the S&P is overlaid. That's on the left-hand side, on the left scale. So this big move here, obviously that doesn't look like a big move in the seasonal pattern. And that's why why I actually put in the rate of change. And then when you look at that, you see that a peak was expected because this is looking at the average seasonal pattern. Rate of change peak expected at the end of the year and then going down to mid-March. And it's kind of what happened here with a little bit more of a peak here. You can also see that these are not aligned. So the peak here aligns with this one. And then that secondary peak, which is a lower peak in the rate of change. So you got to, it's not a perfect solution. It's not a perfect guide, but what you need to look at is where the highs and lows are being made. And the rate of change gives you a bit more granularity and because it magnifies those moves. And then you see that big low comes, it happened in April, according to seasonality, should have gone mid-March somewhere. That's kind of the margin that you need to take into account. And then you got this massive rally. We actually had this little, high-low rotation happening right here, but this year's market was way stronger than it has been in history. However, we are now approaching an area, a time, where the market usually peaks. And it's going to be interesting to see whether we will see the market dropping, and the low is projected somewhere in October, at the 6th of October. So that's about 3-4 weeks from now. I mean, this could, if we see just a little dip here and the market, bottoms out at 635 or 630 and then continues to move higher, then this seasonal pattern was almost perfect. So don't get confused by the distances on these seasonal outlooks because they are more of a guide. They don't tell you anything about the move. Look at this move here. That's the only thing I want to share with you on how you read these charts. Now let's take a quick look on where the sectors are. And I have them both on price seasonals, but also on relative. And because of time, I'm only going to look at the relative rotation, the relative seasonality for each sector. Obviously, there's no relative to the S&P for SPY, so that's the pure seasonal pattern for SPY. But for the sectors, we're going to look at the relative seasonal pattern. So what you see here is the shaded is the seasonal pattern, and the black one is what is actually unfolding now. And below it again is the rate of change for this one that corresponds with this one here and is actually magnifying it. And you can see how the movement of materials, the materials sector, is actually deviating from its seasonal pattern magnificently in terms of price movements. So the decline usually doesn't go more than -3%. And this year, or actually in 2024, I should say, we have seen a drop of almost 21%, and we just recovered. And if we look at 2025, out of this low, we rallied. We peaked a little early because the peak was expected somewhere in March, and it actually happened at the end of March. So it was expected, what's this? May, sorry, 5th of May. And this is March. So we peaked early, got into the decline, and we're now, the seasonal pattern says that we're kind of bottoming out. And it could happen here, but there's maybe a little bit more, but the projected low for materials is at the end of the month of September. So one more week probably. So that's going to be interesting to watch if materials will then pick up and how far they will pick up. Now let's go to the relative seasonals for communication services. Very different picture, as you can see. So here again, the shaded area is the projected relative move. And here we have the actual move that's unfolding right now, following the pattern reasonably well, I'm going to say. The only thing is that we have the high was projected in July, halfway of July. It looks as if we made that high 23rd of June, week of 23rd of June. And the question is whether we need to unfold further. And again, this is the 6th of October. You will see that date coming back in many sectors, but it could be that the relative strength for communication services needs to be under pressure a little longer. You can see here how that works with that movement of rate of change. So not too bad. Looking to form a new low anywhere around the 6th of October, and then a further movement up for the communication services sector. Let's go to energy. So here's a relative move of energy. Again, this is a very stable seasonal pattern. This was happening, it's the average over 20 years. This year was, or the last 2 years, energy sector has not done very much. Now, here's an interesting one because you can see that this is what's actually unfolding. And the projected bottom for the energy sector is on the 11th of August. Actually, that's already 2 weeks ago. And it coincides with a real bottom in the energy sector. So for the energy sector, the relative outlook is for it to start picking up relative strength going forward into the 6th of October, which is where then the outperformance stops. Did we see that 6th of October date anywhere before? I think that's cool. So we had materials, we had it for SPY looking to maybe lose relative strength into the 6th of October. And then we have energy, which is, from a seasonal perspective, expected to show strength into the 6th of October. So this could be a sector that is outperforming in the next couple of weeks. Now, obviously, the big question is, how far will that happen? Because if you look at the relative trend over the last almost 2 years, it's disastrous. It's 20% lower over 2 years. So even if this picks up a little bit, that relative trend is still going to be massively down, despite a little bit of uptick that we may see in the next couple of weeks. So don't confuse this with a rise in price. Also, don't confuse it with energy all of a sudden becoming one of the strongest sectors, because that's not what this is doing. We go to financials. We saw some improvement there, especially on the equal weight version of the RRG. And if you look at the chart here, then here's the expected. So financials actually been doing a lot better than the seasonal expectations warranted. And if you look at the rate of change here, so the bottom, that was this bottom right here, and we're now in the process of rallying, and we could rally until the 22nd of September, which is where a new peak is probably going to be formed, maybe here until the 27th of October. If it lasts a little bit longer, obviously this is a leading indicator, rate of change is a leading indicator. So the outlook for the financial sector, I'm going to say, is not too bad for the next couple of weeks, based on the seasonal pattern. And then we've got industrials, which is one of the stronger sectors at the moment. We've seen that. Here is the actual price unfolding. And what I think is cool and interesting is that we were expecting a low in the industrial sector in the first week of July. And it seems as if it happened 3 weeks later, 4 weeks later, 11th of August. And we're now moving higher, and that looks to be matching the relative trend of XLY over the last 20 years. And you can see how that momentum, that rate of change is backing up that move. So industrials, from a seasonal pattern, expected to one of the better sectors, especially going into that first week of October where it starts to fade, but still remain positive. So it's losing the momentum, the rate of change, but look at the seasonal pattern through the end of the year. It looks as if this sector is bound to continue to pick up relative strength towards the end of the year. And now technology, super interesting sector, of course. Everybody wants it. This is interesting. Here is the last 20 years. Nice, solid uptrend. Look at the magnificent divergence, differences between what's actually happening in 2024 and 2025 versus the seasonal expectations, both on the downside, but also on the upside. So we've got this massive decline going to 11% under, and now we're from 11%, we already rallied more than 11%. We're still below, when we anchor it back here. But if we would anchor that chart here in March, technology would be way above its seasonal expectation. By the way, this is a very good example on why RRGs work so well, because they are not anchored to a historical date, which is what most of these relative strength charts are doing. Anyway, peak, rate of change peak, mid-July, going down into the 6th of October. Looks as if we have peaked a little late, 4th of August, and we may see some pressure, and I think we're already seeing that. And remember that RRG tail that's rolling over on the right-hand side, so it's a really strong trend. Cool, that's what's happening. It's losing relative momentum right now, and that's what you see here in this period from, let's say, mid-July to the 22nd of September, maybe a little the week of 6th October, is where you see sideways to down move in the technology sector. That's rolling over, that's putting relative strength under pressure. So that could happen here, and then I'm looking for a new low, a new seasonal relative low for the technology sector between, let's say, the 22nd of September and the 6th of October. And then we have consumer staples. Talking about differences. This is consumer staples, very kind of boring, quote unquote, sector. If you look at it historically, it's also historically an underperforming sector, which is also very interesting. But you can see how there are massive differences, because here from minus 14 to plus 3, that's a 17% relative move, and then all the way down again. I think that is super interesting to see. Although I have to admit that the seasonal pattern seems to be, I don't know, maybe completely gone here. We've got to wait and see when there will be a new low. This one actually coincided pretty nicely at the start of the year. And I think that the peak here in April 25 also kind of nicely coincided with the expected peak. It was a little early, but we got this peak here. And then we are moving down now. And so I'm not sure whether this is the low that matches it, and we should see some sort of a rally. Very hard to say. So I'm going to leave these type of charts when there is no very clear alignment. I'm just going to park them for a wait and see approach, and see when there is a new low being made and some more significant moves are becoming visible, and I can align them with either the expected seasonal relative or its rate of change. And we have real estate. Again, clear differentiator between the expected seasonal pattern and what's actually happening. If we look at the position of the highs and lows, then this year we had a little late peak in May where real estate peaked March, April. We are maybe still need to get into a low here and then get a little bit of a peak into mid of September. But then the outlook for the end of the year for the real estate sector is kind of flat, and flat in terms of rate of change means a decline. So the outlook for the real estate sector from a relative basis, seasonal pattern, is not too good. And that it kind of matches with what we see actually unfolding on the relative rotation graph for sectors where real estate is inside the lagging quadrant and moving deeper into it. Here's utilities. Again, a kind of a boring sector, but with huge moves over the last 2 years. We look at where the alignment is, where we can find it. And here, this is why you want to look at a rate of change chart, because the swings in that average move are almost negligible. But when you magnify it and detrend it using a rate of change, you can actually see some patterns unfolding. And you can see that we've got that high, we got a high here, we got this low, a little early in reality, a little later projected. Then we've got this cluster of highs coming in, and it's happening right here. Then you see the decline towards the end of the year. So reality, we also already bottomed at the end of 2024. It was projected to be early 25. Then you got the rally, which is unfolding, peaking in April, And then here it was projected to peak in the first week of May. We got a decline coming, and it kind of almost matches. So the low was set on the 30th of June, and then, the rate of change was projected for the 14th of July. And now we're, the question is whether we've already, is this a very early high, which was projected to be somewhere at the end of September, and are we already in the decline that is expected to go towards the end of the year? Or do we see a little hiccup in utilities before it starts to decline? This is where I bring in the actual relative rotation graph, where utilities are inside the lagging quadrant and pushing further into it. I'm going to expect this decline to continue because the actual relative trend is already pointing lower. So if there's going to be a little bit of a relative hiccup, it's going to be very short-lived, and utilities are expected to underperform into the end of the year. And then we got healthcare. This sector has been the weakest over a lot of months on the RRG. I can't even remember when healthcare was anywhere else than in the lagging quadrant at a very low reading. And the reason is this decline here. So here also a very stable seasonal pattern, and you need to magnify that using rate of change to actually see something happening. And what you see here is the peak that actually happened 2nd September 24, aligning with the one that was projected for August 24. And then we had the low projected towards the end of the year, November, December. In reality, it came in mid-December, so a little late. And then you saw the rally. That rally extended. So that peak, the real peak was on the 31st of March. It was 3 months earlier than the projected one, which is somewhere in February to mid-February. And then we have a decline. So this is now it's deviating from its expected seasonal pattern. And the question is, what's this low? If this is a low, what's it going to align with? Or is this going to decline all the way into December? And because is this some peak that's picking up here? And do we just have a complete deviation from the expected relative trend from April to September based on its seasonal? Did it completely neglect that? And are we now going to follow the seasonal weakness towards the end of the year? So again, healthcare reality on the RRG is a very low reading for the healthcare sector with no improvement in sight on that basis. And it's going to be very hard to justify that from a seasonal pattern as well. And then the last one is going to be consumer discretionary. That was our most interesting, most favorite sector. Again, look at the deviations, look at the massive swings compared to its seasonal pattern. Hard to match. It was quite hard to match over the last 2 years. You see a lot of swings here. That's usually not very handy. We did see a peak here. I am not going to label it. Maybe this peak here aligns, so maybe we need to pick it up from here. And then we have a late low, which was projected for February, and it actually happened in March. And then a bit of a rally with a peak 31st of March, actual projected for 7 April. And then another new peak, which was actually happening 12th of May, projected for the 26th of May. And now we go into a decline, and we see a low being put into place in the week of 28 July, which I'm going to say is a little early for the projected August 18 low. But from here, and look at the seasonal pattern here, is pretty positive towards the end of the year. And the rate of change is kind of backing that up. It doesn't drop below zero, which means rate of change below zero means a decline. That's almost not happening. So this is just a kind of a flat move, which is happening right here. So if that happens, then the low in consumer discretionary, the relative low in consumer discretionary has been set. And we can foresee consumer discretionary as one of the outperforming sectors towards the end of the year, which is what you currently see unfolding on the RRG. So the RRG, the actual move on the RRG is supporting the expected seasonal move. Anyway, that's those were all the sectors. We looked at the cap-weighted sectors, we looked at equal weight sectors, we looked at asset allocation, and we looked at seasonality. A chock-full video. Let me know your thoughts, what you think of it, and I will try to do my best to be back with a new video on RRG and relative strength very soon here on Stock Charts Television.